And welcome to this special report here at XM.com. We'll be discussing gold and the factors that could push the precious metal to new record highs. I'm Maria Pachurdiz, and joining me is senior market analyst Harlambos Pissouros. So Harlambos, since the beginning of the year, gold has had the biggest gains among the major assets. Can you tell us about the recent U.S. jobs data for July and how it may impact the Fed's next moves and gold's trajectory?
Hello, Maria. Indeed, gold has been the main gainer among the major assets under our radar year to date. Although it has been range-bound since it hit a record high of $3,500 in April, I think that investors still have the opportunity to lock profits of around 30% this year. Now, on Friday, the precious metal rebounded strongly from around the 3,280 zone, after the U.S. non-farm payrolls for July disappointed. This increased speculation that the Fed may need to cut interest rates more aggressively than it was previously thought. So, as gold's correlation with the US dollar and treasury yields strengthened in the last 3 months, the slide in the greenback and treasury yields allowed the precious metal to spike higher as the opportunity cost for holding it declined. Now, in terms of Fed expectations, according to Fed Fund Futures, a September 25 basis points rate cut is now nearly fully priced in, while the total number of basis points expected to be reduced by year-end rose from 45 to 60, suggesting that the market has once again turned a bit more dovish than the Fed itself. This means that should US data continue to disappoint, dovish bets are likely to increase, allowing gold to extend its recovery and perhaps resume its prevailing uptrend.
Now, other than the Fed's upcoming decisions, gold traders are surely keeping their eyes on Trump's tariffs as the levies are set to kick in on August 7th. What will the effect of these tariffs mean for gold? And what other factors should traders be paying attention to?
Now, although the US secured trade deals with some of its major trading allies like the UK, Japan, and the European Union, the massive duties announced on Friday that, as you said, are scheduled to kick in on August 7th, heightened not only the upside risks to US inflation, but also they have added to concerns about the performance of the global economy. So, should upcoming US economic releases revive recession fears, the US dollar could extend its tumble on speculation that the Fed may prioritize safeguarding economic activity, even if that means allowing inflation to run hot for a while longer. Gold could benefit from that, as well as from increasing safe haven demand amid all this heightened uncertainty. Now, besides the Fed and Trump's tariffs, another factor that needs to be examined may be central bank purchases, especially from the People's Bank of China. The world's two largest economies, the US and China, failed to agree on extending a 90-day pause on tariffs during the latest round of talks in Sweden, which happened last week. And the deadline for those nations reaching common ground is now August 12th. So should no common ground be found until then, I think that tariffs could surge again above 100%, and therefore a new full-blown trade war between those two economic powerhouses could prompt Chinese officials to resume the selling of US treasuries in favor of buying more gold.
Harlambos, thanks so much. And thanks for joining us for this special report here at XM.com.